A dependable dividend ETF does not need fireworks to earn a place on the operating table. Sometimes the interesting patient is the one with a pulse you can actually understand. SDY asks a simple question. What if you own companies that had raised their dividends for at least 20 consecutive years, leaned toward the higher yielders, and collected quarterly cash while the businesses kept doing the heavy lifting? The answer is not a lottery ticket. It is a seasoned equity income machine with a positive payout trend and a price path that has moved forward. But the supplied strategy description also adds an options income layer, so we need to separate the sturdy dividend engine from any extra payout plumbing and see exactly what the investor is keeping. Today we are dissecting the SPDR S&P Dividend ETF, ticker SDY, issued by State Street. This fund launched on November 8, 2005, and it tracks the S&P High Yield Dividend Aristocrats Index. That index starts with dividend-paying companies from the S&P 1500 Composite Index, then requires at least 20 consecutive years of dividend increases. It is yield-weighted, which means the higher-yielding qualified companies get more influence than they would in a plain market cap-weighted portfolio. That design matters. This is not simply a basket of the biggest corporations, and it is not a screen for whichever stocks happen to flash the highest yield today. A company has to arrive with a long record of raising its dividend. That record does not make it invincible, but it does demand evidence of cash generation, board commitment, and survival through multiple business climates. The result sits in the mid-cap value category. Think of the machine as a quality gate followed by an income tilt. The quality gate asks whether the dividend has kept climbing. The income tilt gives more weight to the qualifying companies offering more yield. Shareholders then receive the portfolio's cash on a quarterly schedule. The supplied mechanics also describe an options income component intended to add premium to the cash stream. We will examine that carefully because dividends and option premium come from different economic sources and carry different trade-offs. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold this or any other security. ETFs can lose value, distributions can change, and past results do not guarantee future results. Verify the current prospectus, holdings, distribution notices, tax documents, and other official fund materials for yourself, and consult a qualified professional who understands your circumstances before making a decision. Let's check the vitals as of August 26, 2026. The fund has $22,110 million in assets under management. That is an established pool of capital, not a tiny experimental launch hoping to find an audience. Scale does not guarantee a good return, but this product has survived long enough to be judged on evidence rather than marketing. The expense ratio is 0.35%. That fee is the recurring toll for packaging the index rules, portfolio maintenance, trading, custody, and administration into one exchange-traded fund. The question is whether the screening and weighting process deliver enough value to justify paying more than a bare-bones broad market approach. Here, the buyer is paying for a disciplined dividend growth requirement combined with an income-oriented weighting system. It is also an equity fund. That sounds obvious, but income investors sometimes mentally file regular distributions next to bond coupons or cash interest. This portfolio owns businesses, so its market value can move with earnings expectations, interest rates, sector sentiment, and recessions. A quarterly payment does not turn stock risk into cash-like stability. The distribution schedule tells you when money may arrive, not how calm the ride will be. The current run rate is 2% based on the latest 4 payments annualized if those payments repeat. That is the honest number to lead with for a buyer looking at the fund today. It is modest, not spectacular, and that is perfectly consistent with what this fund is trying to be. The attraction is not an extreme headline payout. It is exposure to companies with long dividend growth records, plus whatever contribution the stated income process makes, while retaining a meaningful claim on the underlying businesses. The trailing 12-month yield is also 2%, so there is no dramatic gap between stale history and the recent pace. The mechanical annualized figure based on the single latest payment is 2% as well. Agreement among those measures does not promise the next payment, but it does make the current income picture unusually easy to read. Nobody needs to squint at a giant backward-looking rate that has already vanished. The latest distribution was 97 cents per share. That is cash, not a percentage, and it should be judged in context. A retiree focused on current spending may find the rate too restrained. An investor who values dividend discipline and wants more of the total outcome left inside the portfolio may see the restraint as a strength. The payment is one component of the return, not the whole product. Time for the history. The first 4 distribution average was 84 cents per share. The latest 4 average is 93 cents per share. The direction is up, and the latest average stands at 111% of the early average. Credit where it is due, this is not a shrinking payout story. That upward path fits the index's selection logic. Companies do not enter merely because they paid a dividend last quarter. The screen demands a long sequence of increases. Still, an index requirement and an ETF distribution are not identical. The fund's payment reflects dividends across the basket, expenses, timing, and other income treatment described in its documents. A constituent can raise its own dividend, while changes elsewhere alter what the ETF distributes. Quarterly payments can also look uneven because corporate dividends do not all arrive on the same calendar. That is why comparing groups of payments is more informative than declaring victory or disaster from one check. Here, the grouped averages show improvement. The next question is whether that cash growth came alongside a healthy asset base or merely disguised damage to the share value. The latest net asset value, or NAV, is $158.49, compared with a launch reference price of $123.54. The NAV return since inception is 28%. In plain English, the asset base per share finished above its starting reference rather than being slowly eaten away to fund the checks. That distinction is essential. A distribution can feel like income in a brokerage account, while economically functioning as the investor receiving part of the investment back. If a fund repeatedly hands out more than its holdings and strategy earn, NAV can sag even while the cash deposits look generous. That is not the pattern shown by these endpoints. The path was not smooth. The maximum drawdown was negative 17%, so the fund has experienced a meaningful decline from a prior peak. That is equity behavior, not a malfunction. The practical lesson is that a dividend screen may influence what you own, but it does not place a glass dome over market prices. During a broad sell-off, a sector shock, or a sharp change in rate expectations, established dividend payers can still be repriced. For an investor taking distributions in cash, drawdowns create sequence risk. Selling extra shares while the portfolio is depressed can permanently reduce the number of shares available for a recovery. Reinvesting changes that experience because the cash buys more shares at lower prices. Neither choice is universally correct, but it should be intentional. Price tells only part of this story. Cash distributions since launch total $17.17 per share, and the simple distribution inclusive return since inception is 42%. That result is stronger than the price-only experience because the quarterly cash did real work. This is why judging an income ETF from its chart alone can be misleading. When cash leaves the fund, the investor receives value outside the quoted share price. Ignoring that cash understates the outcome. The opposite mistake is just as dangerous, celebrating every deposit while ignoring what happened to the capital. The distribution-inclusive view reconnects the two halves. A plain position in a broad stock portfolio might offer more exposure to fast-growing companies that retain cash rather than distribute it. This fund instead imposes a mature dividend culture and an income tilt. That can lag when investors reward aggressive growth, and it can feel more comfortable when durable cash flow and valuation discipline matter. The correct comparison is therefore not payment versus no payment. It is the complete return and risk experience of this rule set versus the alternative you would actually own. The evidence provided here supports the fund's basic bargain. Investors received cash and the remaining portfolio value still advanced. Taxes, trading costs, and reinvestment choices can change an individual result. But as an autopsy finding, this shows a functioning circulation system rather than a payout supported only by asset liquidation. Now we open the machine. The top holdings listed in the data are Verizon Communications Inc., VZ at 3%, Accenture plc Akin at 3%, Realty Income Corporation O at 2%, PepsiCo Inc. PEP at 2%, Chevron Corporation CVX at 2%, and Medtronic plc MDT at 2%. That lineup tells you this is not one narrow bet. It reaches across communications, consulting and technology services, real estate, consumer staples, energy, and medical devices. Each position arrives through the dividend aristocrat rules, not because a manager woke up feeling bullish on a particular headline. Yield weighting then gives relatively more emphasis to qualifying companies with higher yields. The first income source is straightforward. Those businesses pay dividends into the portfolio. The fund gathers the cash, subtracts its operating costs, and distributes available income on its schedule. The long increase requirement favors companies that have repeatedly made room for a larger dividend, although it cannot guarantee that every company will continue doing so. The supplied strategy mechanics also characterize the fund as using an options income strategy. In that type of structure, a portfolio can sell call options connected to the assets or index exposure it owns and collect option premium upfront. The premium is payment from another market participant for the right to capture gains above a specified level during the option period. If the market stays below that level, the option can expire without surrendering additional upside, and the seller keeps the premium. If the market surges beyond it, the option obligation offsets some of the portfolio's gain. That is the core exchange. More cash now in return for giving away some participation in a strong rally. It is not free income, and it does not remove downside from the stocks. If one of those names falls sharply, the premium may soften the blow, but the equity loss can be much larger than the option income received. What should you watch from here? Start with the official holdings and index methodology. Confirm that the portfolio continues to reflect the promised dividend growth screen rather than drifting into a concentrated collection of troubled high yielders. Yield weighting can become a value discipline, but it can also assign more weight to a company whose price fell because the market sees genuine trouble. Next, compare future group distributions rather than obsessing over one quarter. The established direction is favorable. The question is whether business dividends continue supporting it through changing economic conditions. Read the distribution notices and tax reporting so you can distinguish ordinary dividend income, gains, premium-related cash, and any return of capital. Then monitor the NAV path beside the payments. A healthy income product should not be graded solely on the size of the envelope. Ask whether capital is holding up through a full market cycle and whether recoveries remain credible after declines. Also compare performance with an uncapped dividend strategy and a broad market alternative. That reveals the opportunity cost of the screening rules and any option overlay. Finally, verify the options mechanics in the current prospectus or strategy materials. Look for how much exposure is overwritten, what assets the contracts reference, and how the process behaves in a fast rally or hard sell-off. Those details determine whether the overlay is a light income supplement or a major driver of the investor experience. Clean bill of health. This fund earns that verdict because the complete record shows a durable dividend screen doing what an income investor would reasonably ask: distributing cash, improving its payout average over time, and preserving a higher portfolio value at the end point. The distribution-inclusive result holds up, and the payment pattern is steady rather than promotional. The best fit is not someone hunting for an extreme check. It is an investor who wants a seasoned equity income approach, accepts normal stock market drawdowns, and values a rules-based preference for companies with long dividend growth records. The condition for trust is simple: verify the supplied options description against the live fund documents and keep judging the cash together with the capital that remains. This patient is not immortal, and it is not exciting on command. It is something more useful, understandable. The diagnosis is a functioning income ETF whose modest payout is backed by a healthy overall record, with enough complexity under the hood to reward investors who read the paperwork before they buy. Warning: file mutation verifier. One file, S, were not modified this turn despite any wording above that may suggest otherwise. Run git status or read file to confirm. /user/aferg64/tmp SDY income autopsy narration. TXT patch validation failed, no files were modified. /user/aferg64/tmp SDY income autopsy narration. TXT hunk4 no hint not found, could not find a match for old string in the 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button, it genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment: which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.